Hi, I'm Jam de Magala. Today I want to talk about the Bollinger Bands. This is a very, very popular indicator. The reason why it's popular is because it works. This is an indicator that works. It gives you a real sense of price action, direction, where trends are, where the trend is weakening, where the trend is strengthening, and things like that. But they are also pretty misunderstood, Buy when it's outside the lower band and sell when it's outside the upper band. That's pretty simplistic. So I want to go into some details here, and I hope that this will help you understand how to use this very, very popular and useful indicator. This one is originated by John Bollinger. He wrote the book Bollinger on Bollinger Band, which is really the ultimate Bible on Bollinger Bands. So I definitely recommend you check that out. Here's the Reader's Digest version. What are they? These are adaptive trading bands that reflect changes in volatility and provides a clearer picture of the true extent of price movement. Think about them as trend lines. They are adaptive trend lines with a volatility component, so rather than be straight up, there's an upward channel. Or straight down or trending down, there's a downward channel. Instead, you get these Bollinger Bands that flop all around. It seems like they don't make much sense until you really understand what they are. So again, think about them as trend lines. Defining support and resistance. Let's take a look here. Okay, calculating them. It's standard deviation. It's a statistical methodology, a very, very complex calculation. A lot of times when I teach this indicator, I show a big chart or a big graph of exactly what standard deviation calculation is, just to scare people and tell them. Finally, guess what? You don't need to know that. I'm going to spare you the details on that. Instead, let's just say that it is a statistical calculation to measure dispersion. In other words, how spread out, and we're talking about just closing prices in the market, not intraday's highs or lows or average or anything like that. We're just talking about closing prices. How spread out are they around a specific moving average? Typically, you use the 20-period moving average. You can use the 50-period moving average. You can use the 200. You can use whatever period you want. I like to keep it straight and simple. 20 period. So if it's a daily chart, the 20-day moving average. If it's a weekly chart, the 20-week moving average. So you look at that moving average, and again, moving averages can be moving higher. They can be moving lower. They can be trading sideways. All we want to know is we look at that moving average and how close or how far are all the closing prices relative to that moving average. This is obvious, but sometimes it's obvious after it is explained. If it's a 20-period moving average all we care about, the only thing that the bands are calculated on is those last 20 periods, those last 20 data points. So if we're talking about days, I'm just going to revert to that. Days, the last 20 days. As we get a new day onto the front end, the 20th day pops off at the back end. So it's a walking set of prices. How far apart or close together are most of those prices? The larger the standard deviation, the greater the containment of prices. Put another way, these Bollinger Bands are dynamic. They spread out, they get narrow, they called a volatility squeeze. They get wide, that's called a volatility expansion. Narrow again, so why do they do this? Because they adapt to the prices. If prices are all over the place, just all over, then the Bollinger Bands widen out because they've got to contain those prices. If the prices are really kind of chopping around in basically the same level, the Bollinger Bands narrow. Why? Because they don't have to be wide. All they do is they want to contain the prices. They want to wrap themselves around the prices. And that's why we get this widening and narrowing of these Bollinger Bands. So let's take a look at it, and I'll get to the chart so you can truly understand what's happening here. Okay, so one standard deviation. This is the midline right here. This would be the value of the 20-period moving average. This is one standard deviation above, and this is one standard deviation below. Most of the prices are going to be hovering right around the midline, the 20-period moving average. Well, in order to contain, if you have one standard deviation, you're ultimately going to contain only about 68. We'll call it 70% of the closing price data. So there's going to be prices that are outside the bands quite a ways. Frankly, to a point where they really don't do you much good. Two standards deviation, that's the normal. Statistically, they are supposed to contain 95% of the closing data. Actually, this is a study done by John Bollinger. They contain about 90%. So, on a two standard deviation setting for Bollinger bands, about 90% of all the closes are going to be inside the bands. And this is important because, again, if the prices are all over the place, they're up and down and all around, then those bands are going to have to be really wide in order to contain 89 or 90%. On the other hand, if the prices are all kind of clustered, let me get rid of this here. If the prices are all kind of clustered in one little general area, then what happens? Those Bollinger Bands don't have to be so wide in order to contain 90% of the prices. Now, if we have to go out of 3 standard deviations, and this is a whole different trading methodology here that I talk about at Stock Market Mentor sometimes, and certainly in my live workshop. 3 standard deviation. When you got these Bollinger Bands that are really wide, 3 standard deviations, they contain 99% of the closing price data. Only 1%, 1 out of every 100 days, statistically is going to be outside the band. By the way, when you see that 1%, what do you think is probably going to happen? Maybe the next day or the day after that? Well, the prices is going to fall back within the Bollinger Bands because statistically, that's what it does. So, at this point, and by the way, that's not a simple trade either. You can't just say, okay, well, if the price closes, I use 3 standard deviation, a setting of 3 as opposed to 2. If the price is above the upper band, that means I get to short the stock. If the price is below the lower band, then that means I get to go long the stock because the stock definitely is going back up. No, it's more complicated than that because of the width of the bands. Bands are adaptive to volatility, so certain conditions, this is absolutely a winning trade. Up above the 3rd standard deviation, upper Bollinger Band, short that stock, okay? Down below the 3rd standard deviation, lower Bollinger Band, go long that stock. Other conditions have to exist in order for that to be a very, very high probability trade. But that's for another video, okay? Here, we're just looking at, okay? So, this is how we look at them. Bollinger Band calculations. 20-period moving average, that's the midline. 20-period simple moving average. 20-period simple moving average plus 2 standard deviation, that's the upper band, okay? 20-period simple moving average minus 2 standard deviation, that's the lower band. So the prices, ideally, 90% of them should be within this range here. Here's where it really gets interesting, and this is why you have to know this, okay? It's a relative indicator on an absolute indicator, a nominal indicator. It's easy. $45 is always higher than $44. Sometimes, when you're maybe in first grade, that's not always the case. But for most of us, we get to a point where we know if a stock is $45, that would be $1 higher than $44. Okay? $100 is always lower than $110. Bollinger Bands are different. $45 actually might be lower than $44. $100 might be higher than $110. Why? Because we're gauging high and low relative to the Bollinger Bands. Relative to that, what's high relative to the Bollinger Bands? What's low relative to the Bollinger Bands? Absolute, just easy. Count from 0 to whatever you are at, and the number that you come to sooner, that's lower, okay? It's that easy. So we're really talking about relative here. What are the prices relative to this Bollinger Band? So we'll look at it this way. Higher highs or higher lows. Absolutely, on an absolute basis, these are higher highs and these are higher lows. Until finally, there's a break of the trend here. We put in a 20-period moving average in the same chart. That's basically right through the middle. But there is some volatility here. You can see the moving average moves up and down just a little bit. And so the upper Bollinger Band could be constructed this way. Now, look how close this last high is. Remember, higher highs, all of these are higher highs. But look how close this last high is to the upper Bollinger Band. It's about right on the money. The next high, it's higher than the last, okay? But it's lower relative to the Bollinger Band. The next one is higher than the last, so we've got this trend line of higher highs. On the Bollinger Bands, though, they're actually lower highs, lower relative to the upper band. Here, basically right on the money. Here, a little bit below. Here, a lot below. So, if you weren't looking at this in the context of Bollinger Bands, but we're instead just looking at it on a price, you would be surprised when this stock broke. But if you look at it relative to these Bollinger Bands, to the upper band, you would see that we've actually had some pretty fair warning that the price was deviating away from these highs. So, you get basically an early warning sign that there's a problem with the price. Now, if we look at the lower Bollinger Band and we put it here, again, higher lows. What's happening though? You can see it relative to the first one. The price is well above the lower band. That's a good thing. Okay, next one. The price is closer to the lower band, so it's kind of lower relative to the first one. And then the next, we've got one where it's just right about on the lower band. So this is again one of those situations where the price is doing one thing, but relative to this Bollinger Bands, what would normally seen as higher lows are actually lower lows relative to this lower band. Now, we put them both together and you can see what's happening. The price, even though it's higher, has actually been dropping away for a while. And even though the price here, even though it's higher, has actually been coming in closer to where it was going to break down. So, you would have had, again, an early warning sign that this price was going to break down. If you had been looking at this in terms of Bollinger Bands, let's take a look at the couple charts. Now, here, an old chart of Google, you can see this stock trending down. Where is the first higher high? You've got a look and say there. This is all within the trend here, okay? Downtrend. And then finally, we get higher. We buy the pullback here and then we ride this on the victory. But instead, if you slap some Bollinger Bands here, okay, what you will see is relative to the 20-period moving average. It had been banging against the 20-period here. This was your higher highs, right here. Even though it's still confirmed to this trend line, this gave you the early indication that this stock was turning. It gave you an early indication that this close above the 20-period moving average, well, that was different. Now, you get the pullback on the first sign that this stock is moving higher. That's when you buy the stock. And while I'm here, look at how this was behaving relative to the lower band. Stock had been basically walking